Joining us now with more on the markets, Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. When we do, okay, we got to 7,800. At 7,800 on S&P, you're like, oh, damn. What are we going to do? Do I need to do anything with my... Are you still at 7,100?
We are at 7,100.
Okay, so you're wondering, okay, 10%, it's not the end of the world. But then it gets all of a sudden down to 7,600 and it looks lower. You still think this is going to be borne out before the end of the year, that the market...
A bigger dip? Yeah. I mean, well, there's a couple of reasons we could see it. And look, I'm a little more optimistic than I was, a few months ago, because what we've seen is multiple compression in a lot of these frothier areas of the market.
Because earnings have gone up?
Earnings have gone up, prices have come down, and in a way, I feel like it's a healthier reset, especially for tech, for semis, software, hardware, like that whole complex. We've seen earnings come in at a very healthy clip. Cash flow is actually pretty healthy, and multiples have come down.
Kind of a rolling correction in some of the
it's a correction
with the prices,
and the PE has come down for a good reason, which is earnings going higher. So I think that there are pockets of the market that now look a lot more rational than they did at the beginning of the year.
When will we get your 2027? What does next year look like to you?
Next year is interesting. So I think, but the one thing I was going to say is we're heading into this sort of seasonally turbulent period.
Yeah.
And I think
September 1st.
The risk is just being in the index and being complacent. You know what I love as a protection against downside in the S&P? Large cap value. And there's a bunch of tech in it. It's not just boring old economy stocks like energy and financials. Tech is large cap value now. And that's why I like tech. That's why I like a lot of these areas of the market that have gotten a little bit more rational. So, I think the risk is missing the upside, but the risk is also being too heavily invested in heading into a seasonally weak period. The way to navigate that is just park in large value stocks, set it, forget it, come back later, and you're going to be doing fine. In fact, what's surprising is even though it's felt like we've been in this very mega cap tech-led market for the last 5 years, if you look at large cap value versus large cap growth, they've performed neck and neck for the last 3 years, 2 years, 1 year. I mean, it's been a very surprising stealth outperformer relative to the rest of the pack.
All right. So when will you give us the target for 2020?
Second question. So 2027. So we all kind of, come out with this around November. And
what are you leaning towards?
I mean, I think it's going to be a good year. What I worry about, I don't think we're seeing any signs.
But if you do 10% for next year, you'll only get to where we are right now, right?
Well, okay. So when we do our year end, our year ahead, we think about where the market is currently, what the fair value is. Even today, some of our models that are based on returns are suggesting a higher year-end target than where we are today. I just think that now is not the time to buy the index and close your eyes. I think there are. I would
always like to be like that if I was a sell side strategist. I would just that would be my permanent.
Buy the index and close your eyes.
Nope. Pretend that I always have a 10% drop in my average in my forecasts, and then we even had Brian on, and he goes, "Well, they can just raise it at the end of the year if they're wrong about the 7,100." He did. He also was talking about some of your economists are looking for 3 or 4 rate hikes.
Yes.
And I go, really? And he goes, well, if that's wrong, then we don't get them. Then we'll say 1 or 2.
Well, forecasting is hard, and year-end targets are kind of silly numbers.
Especially about the future. Right?
But look, I think that there is still a decent chance. I mean, look, you get a 10% correction effectively once a year,
right,
on average.
That's what I said. I'd always have that. If I was a sell side, where it really didn't matter, where I didn't have any skin in the game, I would always have, my target would be 10% below.
Well, I think
it's hard to say 80. Like, you're not going to ever say 8,200 for me. I'm never going to hear that from you, I don't think.
Well, don't be surprised. I mean, we've been very bullish. Like 3 years ago, I was more bullish than I'd ever been. And that was a point at which everyone was forecasting recessions. And I think this is a market environment where sentiment has already caught up with the market. Back 3 years ago, nobody liked equities.
So you think right now, you think it's complacency?
Think we're heading into a recession?
No, but do you think people are complacent right now? Because I think most people. I think most people think that the market's totally overvalued. Every day I see Market Watch, and they write these articles.
It's not a valuation thing, though. It's really a supply-demand sentiment. You've got a lot more supply coming online, less buybacks. Buybacks have supported a lot of that buying in the S&P 500. Now companies are spending on CapEx, which is great for the future, and I'm bullish for the future. But I think we might be in a period, like kind of an air pocket, when it comes to show me the money from some of these hyperscalers. So that's what I worry about. But I do think that there has been a healthy reset in a lot of these frothier areas of the market.
Yeah, I mean, we got to 78. We got to 7,800 really fast.
Don't be surprised.
There are people at 7,800.
I'm at 9,000, and
That's why I want you to call me.
So I'm telling you, we are models based. It's not just okay. I think that the safe bet is a 10% correction, models based. And our models are saying
maybe get some different models.
Supply, demand. Well, I mean, so far they've been pretty good.
All right, Savita, thank you.